Alright everybody, so here's my chart. We started on the 5-minute time frame. I don't normally go beyond the 15-minute time frame to see what my higher time frame is because I'm just scalping primarily. I do, however, keep in mind as the 1 minute as my ultimate higher time frame because I enter on the 5 seconds. Now this can be different for anybody else, but for me in this case, all I need to see is the 1 minute time frame in order to decide where I'm going to be trading. So if I'm looking at the 1 minute, I'll be targeting mainly the lows and the highs of that 1 minute, whether it's my major structure, sub and minor structure, or my micro structure. I normally don't trade the microstructure in the 1 minute time frame. However, I'm always well aware of my major and my sub and minor structure. So with that having said, let's continue. So here what you can see here is I trade the US 30 Open. That is 9:30 a.m. on the New York time. You can see here I marked everything out just to kind of get a general idea of what the market's doing. We had to break a structure here, as you see. I'm going to go here and zero in on this position here so you guys can understand what my train of thought was during these setups here. So let's kind of go in actually at the 9:30 open, which would be right there. Okay, so we're going to go in down on the 1 minute. All right, so here's what I saw on the 1 minute. Okay, I clearly see some order flow, clean order flow on the 1 minute. I need to see breaks of structures, right? That just gives me more the confidence that price is just going to continue bullish. And I'm always teaching, telling our students all the time that there's only two ways the markets move. Price moves in either imbalance formation or liquidity formation. And when I say liquidity, I mean in like a structural formation. So, for example, price either moves like this, right? Very in an order flow fashion, should we say, like this, right? It just continues to do this, right? Now it doesn't have to be this. Doesn't have to be this clean, obviously, but it can be very choppy like this as well. Okay, my computer's a bit slow here, so bear with me here. But it's something like this, right? It could be very choppy. We don't know where price is going, and price is essentially doing all this, right? And then the other way price moves really is in the imbalance fashion, which is strong impulse, maybe a little retracement, another impulse, then another little retracement, or so forth, or so on, like this, right? But there are three ways that we identify imbalance. So if you wanted to obviously refer to knowing how we trade the imbalance, go ahead to our website at RoyalBluFX.com to go and learn with us and see how we do it. So in this case, right here, this is what I would refer as imbalance right here. Now, a lot of people would argue with me and be like, well, no, that's structure, right? Or this is structure. Everything you see is structure, which is true. It's true. It's not wrong. But the way we identify structure or the way the market moves is just the two ways. So let's go zero in on this here, right here. We see that we're on the 1 minute. You see that we have a clean break of structure. 9:30 happened right somewhere down here, like right around here, right? So I came in the markets a little bit later. I'm going to use this and cut the markets here to show you guys what's happening. So once we identify this clean break, we go in on a lower time frame. Just notice I'm going to the 5 seconds here. Everything's obviously fast. I don't really encourage everybody to do the seconds time frame if you aren't fully trained on trading the 5 seconds or the seconds time frames. All right, so what do we see here? You can clearly see that we have that clean break. I do see my imbalance here. Excuse me, my inducement right over here. Okay, this is just this very start of the markets where price obviously induces everybody to go bullish, and then everyone will then be run, right? So all this would be trendline liquidity. All I need to know is where my inducement is, and everything else I just wait for price to come and run everything down, right? And the reason for that, a lot of people say, well, you got to look for your liquidity. Where's your liquidity, right? Well, essentially all this is liquidity. Everything you see here is liquidity, right? This is considered to be a trendline liquidity. But once you start learning the formation, the very fact of the formations of how liquidity works, a lot of it can be a little sort of miscalculated in terms of each individual. And what I mean by that is, you out there, whoever, whatever trader out there has been taught, to look for your, say, double bottoms. So let me just draw this better here. For your double bottom, or maybe triple bottom, or trendline liquidity, or whatever, right? Everyone has their own sort of interpretation of what liquidity looks like, right? I mean, at least in the sense, right? This is the double bottom, right? Then you have your relative bottoms like this, right? And it's quite complicated sometimes to identify what liquidity looks like. So in my eyes, the way I don't like to necessarily look at sort of patterns. I know a lot of people, a lot of traders would argue this too, the fact that, oh, I'm not trading patterns. Well, you are. If you're looking at what liquidity looks like in the market, that is a pattern. How we trade in the markets is very psychological, right? And this is how we teach trading. Now, of course, it's great to see what liquidity looks like in terms of a pattern, but I'm going to tell you that it won't really save the day. It won't save your day. It won't save you in terms of knowing how well you should trade in the market, like how well you will be trading the market. I always tell a lot of my students that identifying liquidity in the markets is sort of a baby step, into learning how to trade. Right, it's not sort of the official way of trading, but it is sort of like the baby steps that you're taking in. So when you find that inducement, the inducement is really the needle in the haystack, if you will, and in the markets. And once you find your inducement, the rest is over. Everything is the game over, because you'll understand that the inducement is really the deceiver in the markets. Okay, so without me blabbering way too much in here. I'm going to show you what we did here. We found that we had our internal inducement right there, as you can see, the X, right? This formed all that liquidity, so everybody was taken out. However, we also identified our chalk right over here. We didn't specify it here, obviously, for specific reasons, maybe because we were the markets are moving so fast. You can see here again, we found our other inducement right over here. When price broke structure, we just found out that there was the inducement right there. And then anything below the inducement is where your entry is. All right, now knowing that this had a internal structure forming inside here, you guys can see that internal structure. You guys can see that we had a major high and a major low. Inside that major high and major low, there is internal structure. And sometimes there's internal structure and sometimes there isn't, okay? So whenever there is internal structure, always refer to your last chalk. In this case, it was this, right? That's where we identified as where that last order block, or at least the imbalance in this case. You can call it imbalance or order block. It really doesn't matter, because the markets, when they come and mitigate, they either fill in the imbalance and then mitigate the order block, or they just fill in the imbalance and don't mitigate the order block, right? So a lot of you guys were probably thinking right over here, let me just kind of show you here, right here, that there is a down candle here, and you'd be waiting patiently for this candle to be tapped. And then as you see where price goes, just dips below that inducement right there, right? It fills in part of the imbalance, but it doesn't tap the order block, and the price pushed up, right? Why do you think I was able to identify this zone, this fair value gap, split this risk in half, and then just take my first entry right there? Why do you think I did that? Well, it's for specific reasons, is because of this scenario that we know that the market doesn't play out 100% of the time. It does anywhere about 50 to 50%. 50% of the time it does certain actions that we all want, right? Not everything is 100%. So that's what we're taking in an account here, that not everything is 100%. So we entered here, right, targeted the high, and you might be asking, why did I target the high? Well, the reason for that is because we have a weak high. This high was not able to break the low, and so that way we understood that we have a strong low, right, and a weak high. If this strong low is able to break that weak high over here, then we understand that we have a strong low. This low should hold. theoretically should hold, right? A lot of you also may argue, well, why are you entering here so aggressively, right? This can be an aggressive entry versus a confirmation entry. Well, I'm going to tell you guys this, that a lot of the times, and I've learned this through over time I've learned this, that where confirmation entries can kill. Okay, it's not a bad thing. It's not a bad. Let me just rephrase that, because I know a lot of you guys out there will argue with me on this one. But confirmation entries are sometimes too late, right? It's sometimes too late to take a confirmation entry, and the reason why I say this is because you might have been in a scenario where price comes to your, so let's say, demand zone, supply zone, fair value gaps, what have you, and then you're looking for that, let's say, chalk, for example, that change of character that we all love, right? Well, when that change of character happens, right, you've probably noticed, let's say here there was a chalk, right, and price breaks. Well, I don't know, let's just say price didn't even come down here, right? Didn't even come at this low, and price just took off. And you're thinking to yourself, you're scratching your head, oh my goodness, I had a chalk, and price just, impulsively moved to the upside. I didn't have my fair chance of entering, right? Which then price creates this huge imbalance that we're all just kind of scratching our heads and thinking, why didn't I get my confirmation entry? I should have entered in. I've waited too long, right? Well, this is why in this aspect I enter the way I do. A lot of you out there may say, yes, this is very aggressive, but in my case, my confirmation really comes in the impulse movement here. Okay, my confirmations are all here. If anything doesn't play out here correctly, I'm not taking a buy. Okay, or I'm not entering here. All right, so that's one thing you guys really need to understand here is that when you do have confirmations here, when price comes to your, POI or what have you, right? It's not always the best, if you will, to have confirmation. Sometimes it's best just to take an entry the way I do, because the confirmations are on this side, not here. Okay. But I will tell you this though: confirmations are good for people that are either starting out in the markets, right? It's more for people that are more reserved, it's a reserved who are a reserve trader in the markets, right? They're not exceptionally aggressive, right? The way we trade, obviously, and it's also, I also think for confirmations, whenever you have a confirmation, and I'm talking about on this side, not this side here specifically, on this side here, whenever you have confirmation here, it sort of tells me as a trader that I'm not confident enough about what's happening on the left side here. Okay, so whenever you have a swing low and a swing high created, everyone's waiting for confirmations here, and this is when you're thinking to yourself, okay, I got all this confirmation here, whatever you were looking for here, where you found your POIs. And a lot of people find their POIs and they think, oh yeah, those POIs right here. I mean, this is, I don't know, this is low, this is a high. Maybe my POIs here, maybe my POIs here. So you mark 2 or 3, 4 POIs while price was bullish, right? And then you wait for price to come in, sort of mitigate those POIs, and you're thinking, okay, am I going to find the chalk here? Am I going to find the chalk here? Am I going to find the chalk here, right? And this, to me, is still gambling, okay? Because you are looking for confirmation, in a sense, in that regard, you are gambling in the markets, because you have no clue what prices are doing on this left side, okay, what the market's doing on this side, or the price is doing on this side, but rather, you'd rather, put out your POIs and then start looking for confirmation here, right? Which, again, is, in a sense, it is gambling. You are, in a sense, not understanding why price is doing what it's doing, so therefore you're willing to look for more confirmations here, wherever in the markets, right? So that's why we were able to confidently take this entry and target the highs. Now, we target the highs obviously for a specific reason. We do it because we do have a major, we had a weak high right over here, and we had a strong low. And that's what price, that's why we were looking to target the highs. However, a lot of the traders out there would also argue that we are so high in the premium, right? That why in the heck would we be trading the premium, right? That's, again, another sort of, it's not bad to trade in the premium, it's not bad to not trade in the premium, although you can trade in the premium just as long as you have some, 100%, right? Possibility, more probability that price will perform better on the lower time frame. In the discount if you're buying, right? And in the premium if you're selling, right? Just want to throw that out there for you guys. All right. So let's continue here. As you guys can see, prices went bearish here. We had a chalk. Notice I identified that we had a chalk. Now you're probably thinking, well, why are you on this time frame now? I mean, shouldn't you be moving to the higher time frames maybe and looking at the higher time frames? Yes and no. When I see that the 1 minute, this is my major 1 minute low here, my 1 minute major high, I don't necessarily have to move on the higher time frames. I can just stay in my entry time frame and look to see where my major highs and my major lows are, if this is all I'm seeing, right? But if obviously if price was just impulsively higher and impulsively low, I would definitely need to go refer on my higher time frames to see where I'm going to be trading next. All right, so in this case, I'm regarding this high and this low right there as my major high and major low. Okay, because I'm scalping. Okay, so let's continue here and I'll show you what's happening here. So once we had this chalk, you can see here we had our inducement. I didn't put the X on here again because everything is moving so fast. I waited for price to get up there. You can see that there's liquidity being made, as you see right there. We had all this imbalance here. We had also an internal chalk right here. Remember what I said, whenever there is a swing high and a swing low and there's internal structure, always refer to your last internal chalk, right? So this was my last internal chalk here. I toggled this line chart on here. You can see that I had a low and a high there. So that was something nice to see there, right? So once I played this out, I waited for price to get there and to sell it off from here. Let me just play this a bit. My computer's a bit slow. There we go. So we entered this, right? We had a 1% risk here. Over here we had sort of almost like maybe like 0.75% risk there, right? Limiting my risk is what I like doing a lot. Controlling your risk is essentially trying to limit how much risk you are, in the markets. All right, so once we entered this, right, again, we did the same thing again. We had a break of structure here. This is the next low here because we had a high, a low, right? Price came up here, swept the liquidity. So now this is my next high. This is my next low here. And what I did right in here, now I know it might be a little hard to see, but I want to draw your attention to this here. Okay. The way I do certain things, the way we do our entries is very interesting. Like I explain this a lot in our course, obviously, but we have we have 3 different type of entry criteria for depending on what structure we're trading. We're either trading imbalance or our inducement liquidity structure. Okay. In this case, since we see inducement here, imbalance, we identify this here as our order block. Now, the reason for that is because we obviously have a internal structure in here, so this made more of a sense that this right here would be our entry for this. And sure enough, a lot of traders would argue again. They would say, well, hey, this is very tight. This is a very tight risk for you. Why don't you take your risk zone and put it at least this high? This is more safer, right? Well, yes and no, right? Again, if you don't have confirmation, if you don't know how confirmation works or what we're looking for in terms of confirmation on this side here, right? Then by all means, don't be trading or maybe risk as much as you want here. But since we know how this works, right, we were only able to limit our risk to this zone here and only risk this much. If prices went against us, then we would be out, right? We're not trying to risk more than we should based off of this zone. So that's why we won't risk much up here, right? We would only risk this. And if we're out, we're out. No biggie, right? At the end of the day, I lost a little bit, and I didn't lose as much as I wouldn't be losing as much as what a lot of other people would, right? Like the 90%. So beautifully done here. This trade worked out beautifully for us. We're in another entry here. And now I'm essentially just monitoring this. What I want to show you guys here is that this model here, this entry here, is really our continuation model. It's continuing internal structure from this main high here. What it's doing is it's creating liquidity in the market, if you will. And you'll see why we have this FFG here presented, right? When price broke, it actually never filled in the fair value gap. It just respected our internal continuation structure here, and it pushed bearish here. So all this right over here is building liquidity for this fair value gap. Only for that reason is because we have a swing high that was not mitigated just yet or filled in. Somewhere in there might be an order block, right? But I see fair value gaps for the most cases. And we know that fair value, the way the markets really move is they either fill in fair value gaps or take out liquidity, right? So notice right here, you might be asking me, why am I targeting this low right here? Well, the reason why I'm targeting this low is because there's so much internal liquidity here. As you can see, there's a buy there, there's another buy. So price is essentially coming to sweep everything in here internally, right? And then we had a break of structure here, right? This would be our type 2 break of structure, which would be essentially our entry type of structure. But since we are on the higher time frames, or at least we're treating this high and this low as our higher time frame here, I'm not going to refer to this as my official break of structure, because it really is not a break of structure. It's just our type 2 for our entry, or which will be our entry type 2 structure. So once we TP'd there, we were good, right? We're all happy. We had a 7.6 and a 7.3% on this one, and a nice 6.6%. So we're really good. We could end the day here, but since I'm seeing more opportunity, you know, the idea behind trading isn't to see everything, right? You're not supposed to see everything. This is what I tell a lot of to my students. You know, stop trying so hard to look at everything, but only limit your vision to what you are only supposed to see based off of what we teach in the markets, right? Everything, there's sometimes unexplainable moves that happen in the markets that are just so unexplainable, and you can't, you know, there's no reason for it, right? We don't know what the cause or the reason may be. We may have some sort of idea, right? But in the end of the day, you should only make your rules within the boundaries of how you've established, you know, the markets for in your sake, how it translates to you. Only limit to those boundaries, and so that's why we don't try and chase everything that we see. Okay, I know the markets are going a little too fast here. Let me just break it down here. I need to stop this right here. Let me just cut the markets there. Oh, it actually stopped. Okay. So as you can see here, we identified a chalk. What we do in our academy is we trade ranges. Now it's a lot different than just your typical lows and highs and lows. It's a little different because we've identified the way the markets move. They move in you know, ranges, which essentially you're looking at your swing lows and swing highs, and whenever a swing low and swing high have created, we trade the range out of that. Like right here, for example, there's a main high and a main low here, right? The range starts from this high to this low. So whenever we find our liquidity, right, like right here, you can see that there's inducement right there. We find our inducement, all right? This is considered to be a legitimate area where we're going to be looking for an entry or to sell from, right? From this low, let's start from this low, matter of fact, right here. Right here, this would be our imbalance model, okay? You can see all this is just pure imbalance. And there's 3 types of imbalances that we find that we know how to trade, and it's very effective. We all keep it very concise and very, you know, very simple in our course here. So as you see how price runs, right? This was the last high to this low, right? Well, if you look even closer, there's internal structure that I find right in here. There's a high and another low. Right here, we had our area of inducement right there. So when we found our inducement, we noticed that we had a huge gap right over here. So I noticed that this gap was a bit big for me, so I cut it in half, to our 0.5%, and we entered as soon as price came and tapped that gap, because we knew that we had a high chance that price is just going to go bullish there based off what we analyze in here and based off how the markets moved. Obviously, you might have been taught before where your job is to look at impulses, right, where prices are just exploding from a high or a low, and then you just look to buy wherever the last down candle, in this case would be the last down candle, and you would enter from the last down candle, right? That last down candle would be your, say, order block, right? There's some truth to that, and there's some truth, and there's some no truth to that either. But again, we show you how to enter here in these imbalances and our structures, okay? So in here, this would be considered a structure because we have a high and a low, high and a low. You can see there's vivid structure happening in here. And so what we would do is wait for our liquidity to be swept, right? Notice there's no liquidity in here, but there's liquidity here, right? So we wait for all that liquidity to be taken, and then we look for entries. Now you might be thinking to yourself, well, why do you have this is a confirmation entry right here, right? Why didn't I just enter from here aggressively to sell? Well, that's a very good question. Well, the reason for that is because our zones are rather too big. Of course, I can split my risk 50-50 like this, right? And take it from the opening here, risk my high here, and then pretty much just enter here point blank. I could have done that, but sometimes in these rare cases when you can see that we're actually not really bearish. If I zoom out here, you'll see that we're really not bearish. We're still bullish. This is just a break on to the downside here, but it's really filling up a huge imbalance right here, a huge fair value gap right here. This is all fair value gap. I can extend this to this. This is all a fair value gap the price is actually filling in. So when prices are filling a fair value gap, it's not necessarily a break of structure. It's just filling up a fair value gap on the higher time frames to continue price in the bullish direction in this case, right? So that's why when we sold here, we're not treating this break here as an actual break of structure. What we're treating it as is just a imbalance where price is just filling up the fair value gap or the imbalance. And so in this case, I'm only targeting this low here because we do have order flow. As you can see, there's a chalk here. The highs were broken, right? Then we had more structure break here, so this is a new high broken. So that's why we're only concerned about entering from this high to this low. And this is why I wanted confirmation here specifically, because I knew that if I had my entry here at, say, 50%, I know that my R&R might be like 1 to 2 maybe, or 1 to 3 at most, which isn't really bad, but our limit on R&R is at least 4%, if not to limit it to 5% and up, and anything higher than that. So we entered here. This was a 3.7%, as you can see right there, 3.7, and we held this to this low here. Again, what I try and do is I try and analyze both the sellers and the buyers. What are the sellers doing and what are the buyers doing? This will take some work over time, obviously, but you need to understand this as a trader, that you shouldn't just be one-minded or one-side-minded, right? You shouldn't just be I'm buys today, or whatever. You also need to refer on the sellers as well, because the only way price works is, sellers sell, buyers buy. Sellers sold what buyers are about to buy, right? And in a similar fashion, this is how ranges work. This is how a swing high and a swing low work. So notice why I'm selling here, right? And I'm also looking to buy here is because we have order flow pushing bullish. Yet the sellers here, the buyers pushed the markets all the way up here to sweep the highs here, right? To sweep all this liquidity. So now we're utilizing all this liquidity where my inducement is, right there. And I'm utilizing all that liquidity to sell and push the pressure to the downside. Okay, so this inducement here is primarily, you can see where everyone is selling here, and here also, right? I could have sold here, I didn't because I was looking for confirmation here. You can see how I had my zone here to see for a potential sell. However, price didn't respect it, just broke through my zone, and that's an indication for me to tell me that okay, my zone has been invalidated, and therefore I'm not going to be trading there anymore. I need to simply wait for more data to evolve in the markets, right? So that's why I didn't sell there, and it's a good way to sort of, well, not just sort of, but it's a good way to essentially respect your rules, right? When a zone is invalidated, you're not going to just go ahead and just sell it off, right? Even though this is our swing high here and it's a swing low, if my zone is invalidated, there's no way I'm going to be entering, right? I'm just going to have to skip it and then just throw it away and say, okay, well, let's just wait for something for the market to do, right? And therefore, as you can see, price broke that high and just went off on about it. And so that way, I was able to reestablish what the market was doing now, and sort of adapt to what the market is doing currently. We sold there for a good reason. I'm going to show you guys why we sold there. You guys can see, obviously, this is a chalk there that we see. Now, this is what I was talking about previously over here. If this is the confirmation entry that I'm talking about, this happens 50-50. It doesn't happen all the time. Price could have just easily, impulsively pushed bearish here, like this impulse over here, like the imbalance, right? It didn't have to create liquidity or structure here, but it did. So I was thinking to myself, okay, well, if price does give me a chalk, I will enter here because that's what I'm looking for. I did get all my confirmation here on the left side, so yes, I could have entered here, but for the sake of controlling my risk and limiting my risk, I decided to enter here. And I decided that I would need a chalk here for me to enter, right? If prices flew all the way down here without having this structure here, without giving me this chalk, then I wouldn't have entered. If I toggle my line chart here, you can see clearly we had a chalk right there. Okay, right there. So I marked the high over there because we did have a lot of imbalance here. This wick is a fair value gap for me. So I waited for price to come all the way up there, sweep all these highs, sweep all these little wicks, these little structures where people are trying to sell there. And we swept them, and then I sold. And so this came out the way it was, 3.7%. Now, alternatively to the buys now, I was monitoring what the buyers were going to do, right? We saw that there's chalk there. This is a chalk. We had so much imbalance run up to the upside. I didn't look for buys in this area because there was no reason for price to continue up here because we had all this liquidity and because we had this fair value gap up here that price needed to fill in. So prices may or may not have run bullish here impulsively. So that's why I'm just waiting and referring to the markets to see what they're going to do first. Okay, we entered here aggressively, right? And I want to show you guys something here once price plays here. Let me just see if price plays a little quick here. In this example here, I don't think we had any confirmations for this market here, but I'm going to show you guys what happened here. We had the chalk. I saw where my inducement was, and then we just entered there aggressively, right? You can see how I have a 1% risk here. Price never broke the zone, so I could have just been comfortable to risk what's inside the zone only. Sometimes I leave my risk right below the zone just to, you just never know when price will come and take you out, right? Because a lot of it is manipulated, right? Notice how price comes all the way back here, right, to sweep this low, because this low here now is inducement. This low never broke the high, so it's our inducement, and price just sweeps it and continues. It could have gone even lower, but this is why, again, I keep it very safe here. Yeah, so this was all the trades I've taken today, and I targeted the main high here for the simple purpose because we are still bullish. Let me just zoom in here. I know, look what happened here. Prices dropped aggressively. I wanted to target this high, although this was still a huge imbalance. The price was still filling in. So I actually cut off my trade as soon as we got in there because there was no notice. Oops, hold on a second. There was no notice if price was going to go even higher than this. Given the count that we're still in the premium side of things, this huge low to this high is in the premium on the higher time frame. So I had to be mindful of that. Okay. And then once I left my computer, I saw that my entry here would have worked perfectly. And of course, it was really nice here based off of what we saw here. I saw this area here as my inducement right there, that little red block. So anything below it is my fair value gap, and I entered there from there. And that's pretty much about it, guys. I hope this video was informative, and if it ever helped you, please leave a comment. And if it didn't help you, please leave a comment and let me know what I could have done better, and and if this video ever helped you, and if it did, go ahead and throw a huge thumbs like on this video, because it definitely helps our channel, and it helps the algorithm to show our content to more people and more viewers like yourselves. Until then, guys, I will catch you in the next.